Welcome, everyone. We're coming with another great video.
Yes, we are.
We approach year end with some tax saving strategies, things you could think about, things you could implement before the end of the year.
Things you
2024,
need to deal with.
great year for markets.
It has been. It's been phenomenal.
Fantastic.
Yay, we always love that.
One of the side effects might be that you have more tax implications to consider, which is what this video is all about. So we'll dive right in. One of the first ones you can look at would be the RRSP Meltdown.
Yeah, the RRSP Meltdown is a very simple one. So, I mean, basically what you do is you have an estimate as to what you think you're going to earn for income over 2024. And we're getting closer to that time frame. You can do it now, do it early December. But whatever that number is, look where your high end on that tax bracket is. That's what we want to fill up. So whether we're using a RIF, whether we're taking it out of an RSP, or a LIF, or PRIF, whatever the case may be, what you want to do is find out, if you got an extra $5,000 worth of room to that tax bracket, extra $10,000, take that money out of the RIF, utilize it. That's going to keep it there in that same tax bracket. You're not going to pay any more, but at least that money's coming out. And now you can utilize that elsewhere. Non-registered TFSA, anything along those lines. But you're getting that tax scenario done so that you don't have to worry about it in later years.
Yeah, so instead of getting a big tax hit down the road, you're taking little bits now at the rate. Don't go into a new tax. No, but at the current rate, you chip away at it. That's the whole strategy there. Another good strategy, what we call non-registered accounts optimization, which is a mouthful. But the whole idea is you got the RIFs, the LIFs, the PRIFs, pretty much all the acronyms in the alphabet world has to do with registered accounts. And if you have money outside of that, maybe it's called a cash or a margin account, maybe a joint account. Those are usually into the bucket of non-registered.
Boring.
And reasons those matter is that's a pay-as-you-go system.
That really
is. So every year you can get slips for the income, the interest you've earned, the dividends you've received, any capital gains you've triggered. You got to pay the tax as you go. In a year like this, when you've had big rallies in the markets, you could see a more pronounced tax impact on that account. So these strategies could help. We're going to look at two. We're going to look at focusing on capital gains. We're also going to look at tax loss harvesting. But to understand how those strategies could have an impact, we need to understand the tax impact of the actual account.
Yeah, so we're not dealing with anything that comes out of those registered accounts is basically pure income view. That's the way you deal with it. But when you're earning on that non-registered side, now you have a variety of different things. You could be earning income off of bonds or GICs. You could be earning dividends off of bank stock or say telcos or things along those lines. You also could get some return of capital, which of course is going to reduce things depending on whether you've sold it. And of course, the big aspect is that capital gains. And those are the areas where you're looking at the different taxes going on. So, I mean, interest is taxed fully. Dividends give you a dividend tax credit. Capital gains, well, up until June of this year, they were always taxed at 50%, but now 50% on the first 250,000, over 250,000, you're now looking at 2/3. That's going to be taxed. So all these things can have a big effect as to what you're going to pay in taxes going forward, and you need to sort of have some sort of calculation on that. So again, we're dealing with two strategies that way.
Yeah, and the idea is there's varying taxes depending on the investment.
That's
interest being the heaviest tax, dividend kind of in the middle, and capital gain the most efficient. So the idea is, well, if you have to pay tax almost every year on that account, maybe you focus on the one that's most favorable, which is the capital gain. That's the first strategy, focusing on the capital gain, which would work. You get some timing over it. You don't have to, it only incurs tax when you sell. So if you don't sell, it just builds up and you don't have to pay any tax until you sell. The consideration is that often, the more tax perks there are, typically means there's a little more risk. Like capital gains are normally attributed to stocks or riskier assets, whereas interest might be more attributed to GICs, for example, safer assets. So you have to keep that in mind. You don't want to chase the tax strategy. Suddenly you give everything to capital gain, but now you're higher risk and maybe you're not comfortable with that higher risk strategy. So keep that in mind, but it is one focus, the non-registered accounts. You focus on capital gains. Another one, and this is something we do for clients every single year, is you look for ways to harvest any tax losses.
Yeah, so tax losses are basically one way to counteract gains. As we always mention, don't let the tax scenario drive what your investments are, but these are options, if you already have it, that we should be dealing with. And tax loss harvesting basically says, if we've got a whole bunch of losses that are there and we've realized some gains, capital losses offset capital gains. So if you had 10,000 in gains and you have a loss that you can create for 10,000, well, if you sell that, yes, you don't like taking a loss on anything, but all of a sudden, that 10,000 gain, I don't have to show my taxes anymore because I've eliminated it that way.
You get a tax perk.
Exactly. So what we're dealing is looking at stocks that maybe don't look like they're going to do well, or we can take advantage of this year and sort of limit what you're going to have to pay in taxes going forward. Those are always important things. That's the tax loss harvesting in a nutshell.
Yeah, and the idea there is you realize the tax loss. You can then move that back for 3 years. Maybe you had a capital gain on your tax return 2 years ago. Well, you can realize a tax loss today and then go back and offset the tax and get a refund. Or you can carry that tax loss forward indefinitely. You could use it in the future. So the idea of every year trying to look for that non-registered account, is there something where it makes sense to sell it? Maybe I sell shares of one bank, but then I buy different Canadian banks.
That's right.
Exposed to the Canadian banking sector, but I've kind of created this tax perk along the way.
Which is great.
So that is definitely one strategy. We'll get into a few others here, but people always have questions when it comes to taxes. How do they get a hold of us?
If they want to get a hold of us, you go to chatwithclintonandkevin.com. By all means, send out your questions. It can be anything along the lines. I mean, tax strategies for year end. We're more than happy to talk about any of those.
Yeah.
Any other financial questions you have as well, they will come to Clinton and myself. We are the ones that will be responding to you, letting you know what's going on. It's not getting shuffled off to somebody else. We care about making sure you get that one. There's also another perk that we have on the website now, and
we have a newsletter. So if you have a direct question that, hey, I'm curious about this, chat with ClintonandKevin.com. Comes right to us. If you just want a little more information, it's a weekly newsletter. You get lots of tips and tricks, very similar to these videos. You like these videos, you'll probably love that newsletter.
yes,
As well as our webinars. We do free webinars. We'll be inviting the folks that are signed up for the newsletter. So just go to beckorr.com, sign up for the newsletter if you do want to receive that information. A few more tax tips. One that you could implement before the year end is that pension income tax credit. If you're not taking advantage and you're over the age of 65, you really should be looking at this credit.
yeah, basically, it's if you're over 65 and you're eligible for a federal non-refundable pension credit of up for the first $2,000. So if you take $2,000 out of a RIF, there's a 15% tax credit that you can get. Now, the eligible sources include, as I've mentioned, pensions. That's another one that you can deal with, or withdrawing from the RIF. But you got to depend on which way it's going. And those are the main two areas that you're going to be looking at. And taking advantage of this, I mean, if you can get anywhere where you're going to get a tax credit, you should be doing it. Even if you've only still listed your RSPs, convert them to a RIF for a small amount, get that $2,000 out, and take advantage of the tax credit while you can.
Yeah, so that's the idea. If you're already collecting a different work pension, well, you're probably already getting this tax credit because pension income will qualify for the credit. If you're not, well, then you can move $2,000 out. Can't come from an RSP.
No, it can't.
That's a very good tip. It has to come out of a RIF. So take it out of the RIF. You now have this credit that you can claim on your tax return. Another idea is CPP Sharing. This is not going to be great for everyone.
No.
It works best if someone has a very high income and someone has a very low income in terms of CPP, not overall income. We're talking about their CPP benefits. So if there's a gap in CPP benefits and that couple doesn't already have other pension sources they can split.
That's right.
If they don't have a way to split income and there's a gap in their CPPs, well, CPP sharing could be a big benefit because it allows them to even up the amounts, break it over 2 tax returns. There's a whole formula there about how it works.
You do have to apply.
Yeah, you have to apply for it. So you have to plan ahead. And the formula is based on how long you've been together.
That's right.
So again, we have a whole video on that. So we'll link to the video if you want all the nuances and details about how CPP sharing works. But keep in mind that it is one tax saving strategy. And another, and this again comes to year end, if you get some way to donate securities in kind before the end of the year, you could get a nice tax credit.
Yeah, that can be very huge. So if you've got a large capital gain on something and you don't want to realize that capital gain, but you want to make some donations to your favorite charity or to something along those lines that's going to go on, you can donate those shares. Most charities will accept the shares. And what that does is you're sort of a win-win twofold. A, you are not paying the capital gains on it. And B, you are getting a tax deduction back. So as an example, if you have $15,000 on capital or $15,000 that you want to donate, $10,000 was the original, $5,000 the capital gain. If you send that $15,000 over, you're not paying that $5,000 in capital gains, and you're getting $15,000 in a donation receipt, which can definitely offset taxes going forward.
Yeah, so it's a twofold win there.
Yep.
You get the receipt, so you get in the donation credit, plus you avoided the whole capital gain. So it's a twofold win. So again, this would be for non-registered funds. If you have securities in your RSP, well,
That's not
bad.
help.
But if it's in the non-registered account, just slide it over to the charity. You get the charity benefits. You get a twofold win in terms of a tax return. Some extra little donation tips here. There are different amounts of tax credit depending on the level of donation. Kind of across the board is $200. So if you donate $100, there's one level in terms of the credit you will receive. Once you're above the $200 amount, any amount above that, so if you donate $300, there's $100 above that threshold, you get a much higher tax credit. It does vary depending on province because there's a federal piece, a provincial piece, but you're normally around that 45% tax credit, give or take. So you get a much higher credit above the $200. You can combine it with your spouse. If I do 150, my wife does 150 donation, we can combine and put the full $300 in one person's tax return, so we get some of that higher rate. You can also carry donations forward. You don't have to use them in the year you give them. You can carry them forward, say 5 years, and then combine them to do one big lump sum to make sure you get some of that higher tax credit. So a few additional ways you can take the most of a tax credit while helping out other charities. And
That's right.
The
That's
community.
perfect.
All of this, pulling it together, lots of different strategies. We're leading up to the Becker Orr Model here, Kevin.
The mantra is have a plan.
Yeah.
Before you do any of this, have a plan. As we've mentioned before in many of our webinars and our videos, do not let the tax strategies drive your investment portfolio. You need to have the plan first. These will all be implemented in there, and it can help you a whole bunch, but you have to have that plan. If you don't have the plan, then you may not be accessing some of this stuff that you should be.
Yeah, and we talked about tax loss settlement at a high level here. We have a whole video that dives deep just into that strategy and all the things you have to consider. So please click on that video, and we'll see you again very soon.
Take care.